Hi, Matt McAleer, President, Director of Private Wealth, Cumberland Advisors, June 27th, right at the close, about 4 o'clock. It's nice to be back with you. I left for vacation on the evening of the 12th, which meant I was not here the 13th, and then I was not here the 20th because I arrived home the 22nd. First time that I missed two weekly reviews in a row since we started these in 2019. Now, some of you have been with us that whole period. Keep in mind, we started that with an iPhone. We really started to ramp it up during COVID because those were scenarios where, although John and I were in the office, it was crazy times, and we felt client communication was vital. After COVID, that's when we started putting them on YouTube. So for folks that have been with us, thank you. We appreciate it. What did we do this week? What did we see? Well, let me tell you something. If you told me on the 12th, the evening of the 12th, that when I left for vacation, that on the back end of my vacation, the U.S. would bomb Iranian nuclear facilities, my bet would not have been that the market would immediately rally off of that. Now, we've all heard the terminology about buy the rockets, buy the guns, buy the bombs, buy into that type of scenario, as terrible as it can be viewed. But this was immediate. Sunday night, futures were down. By Monday morning, futures were up. I'm scratching my head a little bit, thought we might get a little bit of a pullback, really didn't come. Interestingly enough, bonds, treasury bonds, were very quiet. Sunday night, I expected to see a strong bid in treasury futures, meaning money coming into risk-free assets, into safe assets. Treasuries were bid up price-wise a little bit, not as much as I thought. So that gets back to something we talk to about all the time, positioning. Coming into the weekend and that action, you had enough negative positioning through futures market, through options market, that this didn't take the market off, didn't take the market by surprise enough to get a big reaction. Just interesting to tuck away in your mind for future trading scenarios. What did we do this week? We let the market work for us. S&P up about 3% this week. Nothing domestically. In our global, we had a little bit of cash left over, so we did buy AVDV. It's a small cap value fund. Has traded very well. As a matter of fact, our global strategy on the international side has been lights out this year. Very strong strength. It's about time. Remember, up through March and April, these countries were still trading below their 2007 highs. So it's nice to see these regions and countries trading well, and it's helpful for a diversified portfolio. 3 or 4 weeks ago, we put up a chart, and I thought it was a powerful chart, and it spoke to and focused on long-term investing and short-term investing. We like to think of those as two buckets. I wanted to share a chart with you again this week because as we run into these scenarios politically, headlines can create behavioral emotion that needs to be controlled. And this chart is fascinating. By the way, if you look at the bottom, all these returns are total returns, inclusive of dividends. Returns for periods greater than 1 year are annualized. And I'll go over that in a moment. What I wanted to point out on this chart, like everything we do, green is good, red is bad. It is the point of trying to time the market specifically with a large amount of cash. And what do I mean by that? You've heard me say for years now, we will dim strategies and allocations. We'll raise a little bit of cash. We'll take the lights down a little bit, but we never flick a switch. We never go straight to 100% cash or even 50%, or rarely 25%. We'll play along the edges. When things get overheated and we're seeing some technical breakdowns, we'll occasionally raise 10, 15, sometimes 20% cash. It's normally short run, short term, looking for opportunity. This chart really does a fantastic job of focusing on how difficult it is to time that specifically. What I want to take a look at is the year 2000 on the left-hand column. Because in the year 2000, over the next 15 years, you caught two vicious bear markets. You caught 2000 through 2002, and you caught 2008 through the first half of 2009. And the point being, with your longer term money, look at how when we get beyond year 10, and again, we mentioned multiple times, if you were just S&P for the first decade of this century, you didn't make any money. You needed international. You needed commodities. This backs that up. You had a flat return or a negative 1% return. Will round up from the 0.9. When you come out to the 15-year mark, even though you caught two vicious beatings on your capital, you have over a 4% annualized return. That is beating cash during that same 15-year period. So I bring this up and I share this with clients, and we share it in our investment committee meetings. We try not to get too cute. We're managing actual capital for human beings, clients that put their welfare and their objectives and their trust in us. We always need to have historic facts in our back pocket when we try to plan for the future, because we know there are going to be nasty years. They do not get outlawed. But if your worst case scenario since 1990, looking out 15 years, was a 4% annualized return catching two nasty bear markets, I think what this tells us is we have to lean on the side of compounding. So again, try to think of your capital that is risk capital in equities or in commodities, to a lesser extent fixed income. Let's talk about commodities. The bucket that's longer term, try to be patient. Try not to make that switch change, all in, all out, or even 50% in, 50% out. You can do that with your smaller, shorter term bucket. So I wanted to share that with you. I have no doubt that we're going to see more volatility. I've mentioned in through March and April, when you've had a down first 4 months of the year, January through April, S&P was down. The rest of the year, historically, has been quite volatile. Does not mean the market doesn't catch up and have a positive year, but volatility is ratcheted up. So we'll be ready for that, and we'll keep in mind the two different buckets. We've got the Moose up next. Moose has the wind in his sails. Bond market rallying. 10-year Treasury below 430. What do you got, Moose?
Hi, it's John Musso. I'm the Chief Investment Officer at Cumberland Advisors. It is Friday afternoon on June 27th. We're talking to you from Maplewood, New Jersey. This is the Moose stopping grounds for many years. Lived here about 30 years. Back here visiting some friends this weekend. This is the bond report for the week. And this week, geez, expect the unexpected, right? A week ago, we weren't thinking about the United States bombing Iran's nuclear stockpiles. But here we are, less than a week later, and what happens? Stocks are up. I think the S&P was up about 2.9% for the week. Bond yields down for the week. 10-year bond yield down to about a 426, down about 15 or 16 basis points. Shorter bonds down even more in yield. So the yield curve steepened by shorter term yields going down even more than longer term yields. Muni yields pretty much unchanged for the week, but down a little bit in the front end. Deals well subscribed for. What drove this? Well, one thing weren't a lot of repercussions from the bombing, at least so far. No loss of life for Americans. That's good. But but more importantly, price of oil, which spiked briefly over $80. What had happened? Came back down. You're sitting here at about $65. So the market's cue from that, no question about it. So in a time when both stocks did well and bonds did well, in a period where you had international skirmish this week, duly noted. And, when you think about the whole idea, maybe expect the unexpected, that is for sure. You did have some help from decent numbers this week in terms of, the economy not too hot and actually not too slow. Jobless claims were a little less than expected. Continuing claims are still a little bothersome because they continue to climb and don't come down. The PCE numbers today were very good on the headline number, 0.1. That's certainly what the Fed is looking for. The core number, a touch higher, 0.2. They're expecting 0.1. They're going to watch on that. We know Jay Powell came out this week, talked to the Senate, talked to the House, and basically said, Fed's on hold for a while. We want to see what the effects of tariffs are, whether there's any inflation that creeps in, a wait and see approach. It's what they've been preaching for a while. You're starting to see a little bit of squabbling in the Fed, though, and other Fed governors talking about, well, maybe we have to look at a rate cut. So, the idea that you're going to dismiss a rate cut in July is probably not wise because that could happen. But certainly Jay Powell is trying to be judicious here. Next week, we will have the jobs number for June. We will have it next Thursday on July 3rd before we go to holiday. It will be very important. We will be back then telling you about it. We hope everybody has a great weekend. Thanks.
Thank you, John. Great info. Have a good weekend.